I think it's a wonderful time to be in real estate, but to use a horse racing analogy, I like to pick the jockey, not the horse. And so look for the good operators. The good operators are going to get outsized returns from the same type of real estate.
Hey, everybody, welcome back to Wealth Unfiltered. After this long-awaited break, we are so excited because we are launching our 2026 Economic Outlook series for multifamily. In this series, we're going to have some of the most distinguished economists here to bring you the 2026 outlook. Everyone from Marcus and Millichap, CBRE, and Yardi will be in the mix. On today's episode, I have Spencer Levy. He is the Global Client Strategist and Senior Economic Advisor for CBRE. As you know, I'm Samantha Parnell, the host of Wealth Unfiltered and the Director of Marketing for Viking Capital. I'm so excited to welcome Spencer Levy. All right, everybody, I'd like to go ahead and welcome to the program Spencer Levy from CBRE. Thank you for joining us today.
Delighted to be here.
So we had you on a year ago, and it was one of our most successful episodes. People love to hear from you. And one of the things that I really wanted to touch on is that our audience, especially as we're continuing to grow with Viking, is that we're really have a lot of RIAs that are trying to build their AUM. We also have lots of family office listeners and retail capital. So I really want to make sure that I dive into some of these questions that will help them for the 2026 multifamily outlook. Specifically because not only are you so well renowned, and I love hearing what you have to say, but your platform, CBRE, is obviously one of the largest investment firms in the nation. And I feel like it's such a good opportunity for people to really understand the people behind all of the words and the data. So again, I want to thank you, but I really want to start by kind of you giving a background not only on who you are, but also how you became who you are.
Well, I think like a lot of things in life, the life of a corporate executive is not a ladder. It is a jungle gym, right? So you don't just go straight up and kind of say, oh, look what you do. I've made a lot of great decisions along the way. I've made mistakes along the way. But I've always remained true to myself. And true to myself is always trying to keep my eye on the North Star, right? Adding value to my clients, adding value to my colleagues, being a good guy. I mean, all these things, I'm not sacrificing any of them for anybody, right? And I think that's the North Star. But I think the career path I took is probably less traditional because I was a lawyer, I was a banker. I've been here for almost 20 years. I've always had that North Star of helping others and helping my clients do better, helping my colleagues do better, and maintaining the sense of who I am along the way. And I think that at times when I've made mistakes along the way, I wasn't true to myself. I was like, well, I'm going to go for that next brass ring because that's the next rung on the ladder. But that's not who I am. That's not what I like to do. That's not what I'm good at. There's other people who could do that better than me. And I think that I really didn't get there until later on in my career. I said, you know what? I'm going to do what I think I not just like to do, but I'm good at. And which is now this never-ending roadshow. I gave over 200 speeches last year. I meet with clients every single day, and just had a client meeting a minute ago. I got another one this afternoon. I got more tomorrow. I mean, it's every day, but I love it. I mean, that's both my greatest strength and my greatest weakness. My greatest strength is I love it. My greatest weakness is I love it, and means that sometimes I'm reluctant to change.
Well, I think it's amazing. I'm really excited to have you back on today. We're going to dive right in with some of the big questions. So I think it's important to kind of give us an idea of where you see the current state of the cycle, right? So are we in normalization? Are we in recovery? Like, where do you feel like we really are for 2026?
Well, I think the big picture is there was an article on the front page of the Journal last week that says, do we just stick a soft landing and nobody noticed? That could be true, but I think where we are is in a good place, but with some fragility to it. And the good place is we think that interest rates are going to continue to come down a little bit. We think we're going to continue to grow, albeit at a relatively slow pace. And we think that capital markets volumes in commercial real estate are going to continue to go up. But there's some cracks out there. And the cracks out there are, we have a really, to use the terminology of others, a K-shaped recovery where the top end of the income ladder is doing well, the bottom end isn't. And that means that businesses that are dependent upon that, retail businesses, multifamily businesses, may have some challenges. There's also challenges as relates to the direction of inflation. Look, we had a very soft inflation report in January last week, which is great, but that beast ain't licked. And if inflation rears its ugly head again, it's going to cause problems as well. But I think overall, the good news is that, particularly for retail investors, and I know you have a lot of retail and family offices investors on this call, the good news is they have a lot of choice right now. And there's a lot of excellent choices. I'm obviously biased. I believe that private real estate's a great place to be. And I think that when you're looking at private real estate, you look at it as a comparison to, say, bonds. And bonds look great. Municipal bonds look great, but they have a finite return to them. Commercial real estate have upside with the capital gains on the end. You get dividends and you get some depreciation benefits. So, I mean, there's a lot of things going for commercial real estate, particularly in some of the sectors that have gotten hit hard. One of our hottest sectors right now, and it's going to shock you, is office. Believe it or not, office, which, was on the front page of today's journal, 12.5% are in default right now. Best office in the best submarket. A great place to be right now. And so I think that it's a wonderful time to be an investor because you have so many great choices. And I think that if you look at commercial real estate objectively, you're going to find a lot of them there.
How do you feel like when you're looking at the tightening cycle and the recovery that we're in, and obviously you mentioned soft landing, but when you look at that versus history tends to repeat itself. So prior cycles that have gone through this, how do you think they compare?
Well, everything is different, right? The scariest words in economics are, this time is different. And next time somebody says this time is different, you grab your wallet and you run out of the room screaming, right? So on the other end of the spectrum, here's the spectrum. On one end, this time is different. The other end is reversion to the mean, right? Those are the kind of the two things. But then again, nobody saw COVID coming. And so that kind of upended things. And nobody saw that inflation coming after COVID, and that kind of upended things. So every time is different. But the similarities are that the future always looks more like the past than you think. People still are always going to need a place to live. They're always going to need a place to store their stuff. That's multifamily. That's industrial. And they're going to need a place to be entertained. And entertainment is retail and other forms of entertainment retail. The big question marks around office. But as I suggested, the best office in the best submarkets is doing great right now. And I know plenty of clients who bought stuff in the last 18 months that wish they bought more. So even some of those asset types that are more challenged have opportunities. But I will say there's been a shift in the capital markets. And the shift in the capital markets is that many of our largest clients are now shifting towards alternatives. When I say alternatives, it's not necessarily multifamily. It could be student housing. It could be senior housing. Not necessarily office. It could be medical office. It's not necessarily retail. It could be an entertainment complex or something like that. The point is, people are looking for places that they have, and I hate to use a technical term here, more operational leverage, because financialization, having the capital markets bail you out because cap rates went down or interest rates went down, that's not going to make the most money in this cycle. Because while we do believe interest rates are going to come down, not as much as they did before. The people who are going to make money in this cycle are the people who are good operators. This is old school real estate. This is what the business used to be like when I got into it 30 plus years ago. So I think it's a wonderful time to be in real estate. But to use a horse racing analogy, we just had one of the senior professionals from JP Morgan on my show. They said, I like to pick the jockey, not the horse. And so look for the good operators. The good operators are going to get outsized returns from the same type of real estate.
Oh, I love that. I'm going to have to use that in when I talk to people or for my marketing. I think it's fantastic.
Yeah, there you go. There you go.
So I have a question. You actually brought a good point up. So we're talking about, where the market is right now, where capital's flowing. But when you look at the cost of capital today, do you think that cap rates have fully adjusted?
Well, cap rates, we like to think that this math thing, doesn't matter, right? Math matters. And, you're talking to the guy who used to write the cap rate survey for CBRE, and you're also talking to the same guy who doesn't like cap rates. And I don't like cap rates. I don't like cap rates because they tell a lot of information and no information in one number, right? But what do you do if you have a transitional asset? The cap rate has no value. And so I think that cap rates have largely adjusted, okay? Are they going to come down slightly? They will come down slightly, but in order for them to come down a lot, I don't see that in the cards because that's where the math comes in. There needs to be a spread over the cost of capital. I mean, that's how it's been historically. Yes, there are some periods of time, and I've seen every chart imaginable on the average multifamily cap rate and the 10-year treasury, and it porpoises a little bit above and below the line. But for the most part, there's a spread between the cost of capital and the cap rate. So I think cap rates have largely adjusted. But that does not mean you're not going to get outsized returns in multifamily or other forms of real estate if you operate it better. And operating it better isn't just cost savings, it's growing revenues better. I use the term all the time, demand drivers, durable demand drivers. If you can create more demand for your multifamily because you operate it better, that's going to be your ticket. So I think it's a changing market, one that's shifted from capital markets focus to operational focus, but it's a great time to be in real estate.
I love that. And when we talk about, that normalization kind of happening, do you see what you're seeing right now? Are you seeing the bid-ask spread finally narrowing and people kind of having alignment on what the pricing really should be in commercial real estate? Or is there still like such a wide? I know last year was like, it was like you couldn't make a deal. Everyone thought value was here and then no one wanted to pay. And it was kind of a nightmare.
Well, I think in certain asset classes, and unfortunately, multifamily happens to be one of them, people overpaid 5 years ago.
Yes.
And some of those people are reluctant to unload the assets at or below what they paid for it, or a price below the IRR expectations for the assets. So yeah, I think in certain segments of the market, there's still a gap. But I think that gap is narrowing as interest rates come down. But actually what's causing that to be challenged is that some of the operational metrics in multifamily and industrial right now are a little challenged. You have some markets in industrial where rents are declining. You have some markets in multifamily where they were overbuilt, though, so they have to give more incentives. So yes, the bid-ask spread is closing overall, but I would say there are still areas that things are not being unloaded in the market at fair market value.
Understood. I think that's a great way to put it. So when you talk about, unloading assets or even how you were talking about capital kind of going towards alternatives more and more, where are you seeing institutional buyers deploying, or are you still seeing them really sitting on the sidelines for now?
Well, I think you need to put it into various buckets, right? If the most challenged bucket is core. Why? Because core may be saddled with some legacy assets like office. They may be saddled with, they might still have redemption queues, right? All right. So those are two challenging things. But at the same time, if you're a new core fund, boy, it's a great time to be in the market, right? With fresh capital, because there's great opportunities right now to buy. But as you move up that risk spectrum, that's where you'll see perhaps more capital in the market. I think the most popular of the sub investment strategies is value add. But nevertheless, I think depending upon the cost and the time horizon of your capital, you'll do everything from buying stabilized, grocery-anchored retail all the way up to new construction. I still believe in new construction, even in a market like today where interest rates are high, where cost of labor is high, because 2 or 3 years from now, when your job is done, you're going to have the best job in the market. And people like new stuff. So downtimes are always good times to build, even though it's the time that people build the least.
Right. Well, you actually just gave me the perfect segue, because what I was going to ask you about was kind of shifting specific to multifamily. 2024 into the beginning of 2025, we saw it marked the record level of new deliveries coming in, new product coming on board. So, a lot of the Sun Belt there's some overgrown areas in like the Midwest and the Rust Belt. So for you, are you seeing that now those have really been absorbed and we're going to see rent growth stabilize and really a positive shift for 2026? Or what are your thoughts?
We think that multifamily is still going to work its way through in certain markets in Texas. Austin, Texas comes up a lot in these conversations. That still has oversupply and they're working through it. But yes, I remember Austin today reminds me of Nashville 10 years ago. I remember 10 years ago, this happened to be in the office sector, but I think the analogy worked. 10 years ago, they said, we just added 10% of the office stock. It's going to take 10 years to absorb this. And I said, no, the number of people moving into Nashville is going to absorb this way faster than you think. And Austin, Texas is the fastest growing city in America, literally. And so it's going to be absorbed faster than you think. So I'm very bullish on even these overbuilt areas in the Sun Belt. I do believe that people will be rewarded by building new, because there'll be very few competitors coming that'll be having new product 3 years from now. So I do think we're going to get to an equilibrium stage. in multifamily by the end of 26, even in some of these markets that seem to be overbuilt because the housing shortage is it's just dire. I'm here in Manhattan right now, and I was fortunate to visit the developer of the largest office to residential conversion in the world, 1,400 units, 25 Water Street. And he told me that a place called Soma. He told me that the New York City alone is 500,000 units short. I think that the U.S. is 7 million units short. And again, we can quibble over you divide them up, you do it by bedroom, you do it by a housing unit. Fine, I get all that. We're short of housing. And you put the housing where people want to be, it's a great place to be over the long term.
Yeah, absolutely. Do you see the vacancy kind of peaking in 2026, or do you think we've already done
I
it?
do. No, I do. I think it we're at or near peak in vacancy in multifamily. And then I think you got to go down the quality spectrum, right? Because when you say multifamily, it's a big space, right? It goes all the way from luxury to workforce to capital A affordable to manufactured. And then you have all the side asset types like senior housing, student housing, et cetera. So it's a big space. But I think when you take a look at the space overall, the driving factor is demand, and demand is driven by jobs. It's driven by immigration, and there's been some pullback in immigration. Will that impact some of the lower levels of multifamily? It may. So you need to look at all these demand drivers, but ultimately the shortage in housing is real, and it will persist for, unfortunately, much too long.
We noticed at Viking, we had a much larger retail base previously. And what we noticed is there was a big flight to quality. People were really nervous, I think, at first about the distressed assets or value add because they were worried about what was going on in the economy. Could people actually create the NOI? Maybe it was safer at the time to just find an asset that would appreciate at a lower basis. Do you find that now, coming into 2026, that still might be this case? Or do you think that core assets are going to be more vulnerable?
I think that ultimately, I believe in durable demand drivers. And I don't like any market, but I like a lot of submarkets. And when I say that, all of my submarkets have the same durable demand drivers. And the durable demand drivers, they're the same five, and they are capital, human capital, live, work, play, infrastructure, and foreign money. Those are the five factors of awesome. And yes, I've trademarked it. No, I haven't. But what's interesting is when you say core, I like to say core assets within these markets that have these durable demand drivers. Those are the ones that are going to do well. And what we're seeing now, again, people come up with all these new terms in real estate all the time. So I remember 10, 20 years ago, they used to call it flex industrial. And then it had a downturn. They changed the name. It's now small bay. Okay. Yay. Right. Now they have these areas that are just outside the CBD. They used to call them the suburbs. Now it's called CBD adjacent. Right. So, I mean, the closer in you get, I guess you're more CBD adjacent. Right. So, but the CBD adjacent assets are the ones that are actually seeing faster growth, faster absorption than many of the traditional CBD assets in many cities. I mean, you go to cities like San Francisco, you go to cities like Dallas, you go to cities like Charlotte, and the downtown CBD area might be soft, but you're going to have areas just outside it, just like North Dallas, just like the area along the new train line in Charlotte, just like Wynwood in Miami. They're doing great. And I think that that's how people need to look at these markets. They look at the sub-markets that have durable demand drivers. That's your ticket.
I love that. I couldn't agree with you more. One of the things that I do is the similar probably to your analyst is part of being the head of marketing is I do a lot of research. I really want to understand everything about the demographics, what we're doing, why we're doing it. Not only understanding like the true data, but also the story, understanding why people are moving there. What is the demand happening? So I find that everything you're saying is like speaking to like everything that I do on a regular basis. I love it, love it, love it. So one thing I will say is, that Viking has been pretty bullish on the Sun Belt. Do you think that we've seen a permanent reset there as far as the pandemic and all of that? Can we say that the pandemic issues are behind us and now it's more of the reset of the actual cycle happening, real estate cycle, or where do you think pandemic effects are still hitting?
Well, jobs, jobs, jobs. How about that for my answer? I think that if you see manufacturing and or head offices move down into the Sun Belt, it'll be durable. You'll also see this demographic shift. You can't ignore that. I think as of last year, something like 10,000 Americans a day were turning 65. And that's certainly been a driver. The retirees and the boomers have a lot of money. I mean, from a generational cohort, maybe the richest cohort in history. So You have to, when you're in commercial real estate, you have to see, well, what is the age cohort? What is the job driver? What are the other demand drivers that I'm trying to, that are going to be indicators of success for the type of real estate that I'm going for? So let's assume, and again, I'm not trying to stereotype the silver tsunami or older folks, but they're going to want a different type of real estate than our young urban professionals and then immigrants coming into the country. And you need to know, well, what type of real estate am I investing in? Am I building that will serve that population?
Very smart. Yeah, absolutely. What about for, the Midwest? I've heard a lot of talk over the last, year that it's kind of been a quiet outperformer. There's certain areas that are booming. Do you have any thoughts on the Midwest as a whole or certain markets that you love or don't love?
You want me to bring out the famous cover of the New Yorker where they had New York, the Midwest, and then California, and it flew over it, right? Remember that one? It's a famous magazine cover, right? But that's obviously a New Yorker's view or some New Yorker's view of the Midwest, or it was, because I think the changes now in the Midwest are real. And the changes really come down to two words: infrastructure, manufacturing. And it's not just the changes under the current administration, it's also under the prior administration of the CHIPS Act that have really driven this. And you're seeing this along the lines of infrastructure. And so the infrastructure, I'll just give you one example. There's a new train line that started in 2023 that better connects Mexico and Canada, and it cuts right through the Midwest. And one of the cities that it cuts right through is Kansas City. And Kansas City keeps coming up on my screens because of A, that train, but B, look, I may not be an expert in everything, in anything maybe. I am an expert in airports. And I say this with love to my friends in Kansas City. Until 2 years ago, your airport was rough. You had to leave security to get coffee. I mean, it was a tough place. Now they put a couple $2 billion into it, and it's fantastic. It's a beautiful airport in Kansas City. So please invite me back, Kansas City. If you have that, combined with the fact they have that new train line, combined with the fact that Kansas City has a lot of wealth in that town. There are several corporate headquarters there. And here's the kicker, and I say this just matter of fact, Kansas City has always punched below its weight, given the size and the infrastructure in that market. Now that the infrastructure has improved, it's the kind of market in the Midwest that I think is poised for growth.
Amazing. So speaking of growth, how do you think investors should think about growth versus like stability over the next year?
Everything comes down to your time horizon.
Okay.
And so if you're a investor that has a 20, 30, 40-year time horizon, I'm going to give you very different advice than if you're my mom and I just sold your house and bought municipal bonds. So I think it all comes down to your time horizon. But for the younger investors, and I don't want to age this things because you need a mix no matter what age you're at. But I think that for certain investors, going out there on the risk spectrum is well worth it. I think for some investors, a more conservative approach makes sense. And as I said early on in this discussion, I guess if there's an upside in having high interest rates, it gives investors today choice that really investors didn't have during the prior decade. There was no choice in the decade between 2010 and 2020 except to go out on the risk spectrum because you just weren't getting those kind of yields and alternatives like bonds.
Right. When we think about rent growth, so obviously you're seeing that across these markets that we're talking about, it's very wide. We're seeing negative to I think up to 6 in some markets. I mean, it's just a wide spread depending on where you are across the nation. What do you think is a sustainable rent growth over 2026 into 2027?
Well, look, that's a very broad question. I think that there are some places that are still experiencing negative rent growth in certain of the overbuilt industrial markets, okay? Some multifamily markets may experience rent growth, but they're giving you extra concessions, so the net effective rent may actually be flat. So I think that for 2026, it's very sub-market dependent. But I think that we're going to get back to a normal rent growth period by next year. And that normal rent growth is that magic 3% number that shows up in all of your offering memorandums by next year. There's some places that are still supply constrained, like here in Manhattan and San Francisco, where rent growth is way above that. I mean, way, way above that. But there are some places that are overbuilt in the Sun Belt that may be flatter, that will be flatter.
Do you think for most people looking into investing in multifamily this year, should they be looking at people who have NOI growth, tertiary markets that just have those, like what you're talking about, those higher rent growth opportunities? Are they thinking maybe some distressed deals that have just appreciation built in at a lower basis? Like, if for the year 2026, like where should they be really focusing their attention?
Well, I think that the multifamily market is big, deep, and diverse. And going back to what I said before about where you want to be on the risk spectrum, there's some multifamily that's going to be poised for immediate growth, right? And those are some of those like senior and student housing and capital A affordable. Okay, those are three subsegments. Manufactured housing, I'll give you another one. Those are probably going to grow faster than Class A multifamily, even in the same markets. Okay, so it's easy for me to say, oh, go buy Austin. See, and aren't rents going down in Class A? Well, they might be, but if you go to Capital A affordable, manufactured housing, student housing, and senior housing, they're going up. So the point is that you need to be discerning as to not only the market, but the sub-asset class within that market that's best poised for growth. Over the long term, I mean, I would buy every single multifamily asset in Austin if I had a time horizon of 10 years or more, all of them, right? But in the short term, some of them are going to underperform some of the, what I would call specialized asset classes like seniors, students, manufactured, and affordable.
I listen to what you say, and I'm like, all of my investment thesis for the year, I'm like, okay, I'm starting to put it together. Where do I want to be? How do I want to structure things? One of the things that we talk about, allocation and trends. So I'd like to understand from you. You guys obviously have done your research in 2026 where you see capital flowing. You kind of mentioned it like briefly that you see value add as being one of the more sought after pieces. Why is that? And is there something that you would focus on in value add?
Sure. So I think one of the most well-known formulas within the multifamily sector, and again, everybody's asset's a Class A asset. Okay, let's just stipulate that. Okay, but they're not. Okay, you can get an older vintage multifamily asset. Let's say one that's 20 years older. All right, they need a refresh. And when an asset needs a refresh, it's not just paint and carpet. It could be new appliances. It could be new furniture. It could be new countertops. There's 100 things you can do in a Class C or an older multifamily asset. And that's what a value add asset is. Now, you might go in there at a cap rate that scares you, right? Oh my God, this is a 4.5 cap for this old asset. Well, the reason why the cap rate's 4.5 is because you're going to be able to put in all of these improvements, and then your rent growth is going to be 10% when the market is flat because you've put in all of these CapEx improvements. You're going to have a better asset than everybody else. And it's a well-known formula within multifamily, buying a C, turning it into a B. Okay, that's why value add is so good, because it's a well-known, well-worn, and a very good formula. And there's great demand in B and C. All right, there's just the demand in B and C is stickier from an overall perspective than you're going to see in the A, because the B and C, and I say this not pejoratively, just matter of fact, the A multifamily renters have more choices than do the B and C renters. And because of that, their durability is greater. And because of that, your ability to use capital improvements to increase rent will be greater in those units, while in the Class A segment, you'll see the unit owners or the unit renters have the choice to rent another Class A unit that comes on the market, buy a house, or do something else. But the bottom line is, when you're looking at the long-term cash flow stream, you need to look at the durability of that stream, in part based on the demographics of the renter.
Yeah, absolutely. One piece I think you kind of talked about as well is you touched on is obviously there's going to be pipeline issues, right? So one of the things I wanted to kind of touch on was kind of the debt world and kind of understanding the financing and refinancing of what's happening. So we've seen a lot of what you call distress happening in the multifamily market. I think you've seen a ton of it in office space. And one of the things I wanted to ask you was, how significant do you think 2026 to 27 refinancing is going to be for the pipeline for new acquisitions, or for people to, just get new capital in?
Well, for new acquisitions, the market is in great shape for multifamily. For refis, that's where it gets to be a little dicier. It gets to be a little dicier because, if somebody paid a 3.5 cap for an asset that you and I would both value at 5.5 cap today, that's a big difference, right? And so I would say now that's the bad news. The good news is, even for that type of capital, that cost of capital is coming from something that was double digit to something that's high single digit. So even there, the market has improved. But nevertheless, you still have quite a few multifamily assets that were bought in that, call it 18 to 21 period, that are still going to have to go through some type of refinance that may not be as attractive as a new acquisition.
Do you think that there's going to be, big players who kind of come in and rescue and actually do rescue capital? I heard a lot about that last year, as that was going to be like distressed opportunities. Or do you feel like they're kind of shying away from it with disinterest?
Well, I'm not going to tell you that ship has sailed, because there are a lot of very big players providing different types of capital to different pieces of the capital stack, preferred equity being the most notable one. That's the segment of the market where the cost of capital has come down substantially. It's come down substantially on mezzanine debt as well. So I think there's still money out there for that. I don't think that ship has sailed. I think we still need it. But I think the good news is that the cost of debt at the least risky tranche, the A piece, right, has gotten cheaper and more available and more liquid. And the beauty of multifamily versus every other asset class, I consider this to be the single biggest inefficiency in all of real estate, and we should use it to our advantage. And that inefficiency is that because Fannie and Freddie will provide a multifamily deal, the same financing in a second tier, third tier market as they might in a first tier market, you need to back up that truck all day long, particularly if you're dealing in the mission driven segment of it. The mission driven it's not just workforce housing. It is housing where your rent is below a certain amount of the AMI, average median income. And if you're in that sort of category, you get even cheaper money. So it's an inefficiency. Inefficiency doesn't necessarily mean a bad thing. It means that you can use it to your advantage.
And talking about, lenders, are you finding that the lenders are still working with people? They're extending and restructuring, or are they, at this point, they've had enough of it after the last year and a half and are just forcing sales?
Well, there was a front page article on the San Diego Street Tip right today. I'm glad I read the newspaper on the way in today, right? Look, I think that there's a lot of people that are still, quote, kicking the can down the road. And I think that kicking the can is going to continue as interest rates continue to come in, and the winners and losers are going to be more and more sorted out. So I don't see any great moment of epiphany where everybody says, give me back your assets. Because what are they going to do with them? Market value is market value, whether it's owned by the bank or it's owned by the developer. And so they can't create market value. The only thing that can create market value is a good, well thought out, executed business plan. And generally speaking, even though I love all my lenders, they all know this to be true. Having it in the hands of the developer is, generally speaking, better off for everybody.
Okay, I love it. I love your insights. Thanks for reading the paper as well.
You bet. Yeah, at least I got that going for me.
I know that I've taken up a bunch of your time. I just have a few more questions I want to run by you. So I kind of want to do forward-looking questions. Looking into the year, we know that there's been a lot of talk of like dry powder on the sidelines, but we've been seeing a lot of really big transactions happening. We've been seeing them taking over major portfolios in the multifamily sector, office spaces. I mean, there's been a lot of even like mixed retail use. Like we're seeing them have at least some of the major players are coming in with hundreds of millions of dollars, billions of dollars, and like taking over portfolios. Are you in the mindset that 2026 is just the beginning and we're going to see even more of that? Or do you think they're really going to stay on the sidelines and just continue to let the highest kind of deploy and wait?
I think you're going to see a lot more M&A in 26. I think you're going to see a lot of it. And the reason is very straightforward. It's because, A, there's a lot of capital on the sidelines. B, and again, I'm not here to talk positively or negatively about publicly traded versus private companies, but there's a lot of opportunity in the public space. And I would say that the bottom line is that you're going to see M&A activity increase this year as debt remains available, debt gets cheaper, pent-up demand. And as I said, real estate's a great place to be, and your time horizon will determine which segment of the market you go after.
Absolutely. Do you think that there's a specific market that offers like the best risk-adjusted returns for this year?
Wow. I love this question. How direct should I be about this? Well, I want to name two of them. Well, I'll name one. Of them. Okay. San Francisco. Why? Because I called San Francisco 3 years ago. And because 3 years ago, everybody was scared to death of San Francisco. They had all kinds of political and other types of issues. And I'm like, let me tell you something. There ain't no market in the world that has better durable demand drivers than San Francisco. The amount of wealth, the amount of intellectual capital, the infrastructure, the live, work, play, all of it. I'm a huge fan of San Francisco, and I remain a huge fan of San Francisco. By the way, I'm a huge fan of New York too, and and that hasn't changed. So I like these big markets, but again, I like sub markets within these big markets. I love Dallas, but I don't like every sub market in Dallas. I love Miami. I don't like every sub market in Miami. The point is, there are great submarkets, particularly in these markets that have great durable demand driver. I mean, I'm like a broken record on this call, but if you have these five factors of awesome, and the five factors, I'll say them again: capital, human capital, live, work, play, infrastructure, foreign money. That's the ticket.
I love it. I love it. Well, I was going to ask more questions, but I actually love that final soundbite. I love where you're ending this. So I'm going to say thank you. Thank you so much for taking your time with me today. I absolutely enjoyed having you on, and I'm sure our listeners learned a lot and are very excited in order to start deploying some of their own capital this year and follow your advice.
Well, please do. It's a great time to be in real estate. There's lots of choices in the sector, and I'm sure you're going to find great choices for yourself.
Amazing. Thank you to all of our listeners for joining us again. Stay tuned for the next episode.